Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Joe Tigay, managing partner at Equity Armor Investments, for an update on what's going on in the market. And Joe, it was really an interesting start to the year. We saw those beaten down stocks in the first quarter of 2023 that were really beaten down in 2022, came back with a vengeance and kind of reversed that trend this week.
Yeah, it was a great first quarter. There's no question about that. And maybe one of the things that was happening in the first quarter is that expected weakness in the economy just wasn't showing up. We saw really robust jobs growth, really strong economic numbers in the first quarter. And maybe that's starting to unwind a little bit this week as we're starting to get a little bit of softening in the jobs data. But yeah, some of the worst stocks in 2022, some of the stocks that were punished because a recession might be coming in 2023, had a great run to start the year. Stocks like Facebook just had tremendously oversold in 2022 and a tremendous run in 2023. Really interesting to see that just played the whole quarter. And then this week, we're kind of questioning that narrative, and we'll have to see how that plays out. Of course, a really important jobs number tomorrow.
Yeah, and economic data is coming in. That's kind of working in the favor of the Fed. But what's interesting with tomorrow is the equity markets are closed. Government offices are open, so that key piece of data that we look forward to each month, the non-farm payroll report, is going to be out, but equity traders are not going to have the opportunity to trade it.
Yeah, it sets up for a very interesting week next week. It's really a shame for all of us traders. We'd love to be trading tomorrow around that economic data, because it seems like a really important jobs number where for the first time, we saw a weak ADP number, we saw a weak JOLTS number. We're seeing, job losses potentially out there, but we'll have to wait and see. We won't get the chance to trade it until next week. And also, usually around these big economic data points, we see volatility rise into that event, and usually into a 3-day weekend, you see volatility suppressed into that event. So it's really an interesting dynamic where you have one factor lifting up volatility, one factor pushing down volatility. Right now, it seems like volatility is trending a little bit lower into the 3-day weekend.
And that really has been the theme of the market this year. One data point means this, the other one means that. There's so many either or scenarios that are out there, but in your notes, you say vol is subdued, bonds are pricing in a recession, equity markets haven't priced in a recession, so who's got it right?
Well, historically, I would lean toward the bond market. They've been right more often than not. We'll have to wait and see. Now, they were pricing in this recession last year. Everyone was expecting it. Didn't happen in the first quarter. The equity market really liked that. One thing that was interesting, maybe not so much today, but the start of this week, we saw that weaker than expected data. We saw rates fall, bonds do quite well, and we also saw stocks lower, including the growth stocks lower, tech stocks lower. So that has been a little bit of the unwind. Maybe the bad news is bad news narrative is starting to hold, and I think that has been what has happened historically. When the economy does soften, when interest rates fall, that usually means earnings also fall, regardless of it. People thinking it's priced in, it usually isn't priced in, and the stocks do suffer when interest rates, when the Fed does lower their benchmark rates.
Right. Well, I guess we'll start to figure out really what's happening in earnings, not only what came out for the quarter, but what guidance looks like going ahead. And of course, we start with the big banks next week, and the banking story, from the second week of March until where we are now, really has taken over the narrative in the market.
Yeah, so that's been the first thing that's broken with these with the interest rate hikes the Fed has done really quickly. Interest rate hikes. We saw some of the regional banks get hit very hard, and that happens when interest rates rise. Historically, things break. Now, I hope that we have seen the worst of it in the regional banks. I hope that there is nothing else about to break, but usually things are in the most stress. Things break the most when the economy is doing the worst. So again, we are just at the start of this softening in the economy. I'm not saying that we're not necessarily going to see a soft recession or a light recession. That's still a possibility, but we're still very early in the economic slowdown.
Yep, and you have to trade what the market gives you, don't you, Joe? Appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.